Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the team at Gulf Coast Financial Services. Founder and CEO John Kuykendall here with us, as always, is our resource. And John, we always appreciate your time.
Thank you, Peter. I am really excited to be here. I think that the program today is one of the most timely we could do. It's talking about emotions and the 5 mistakes you can make and why you need to let your advisor help you through those. I just got a phone call this morning that spells all this out, and we'll talk about it later in the show. But this is a very timely segment.
Well, I know that we can make far more than just 5 financial mistakes, but there's 5 big emotional mistakes that lead us to money mistakes. And John, I imagine having an advisor to guide us, to formulate the plan, to hold us accountable to the plan probably helps the average investor avoid a lot of these emotional money mistakes.
Well, I hope so. I mean, that's what we're here for, and that's what we believe we do, because, it's an emotional roller coaster, the stock market. And people, they always want to buy low and sell high. And unfortunately, they end up buying high and selling low because they just don't have the emotion to stay in the market when things are going bad. And so emotions, as I've always told my clients, emotions are the biggest thing we have to overcome to keep you in the market. And as I was saying earlier when we started the show, just today I got an email from a client. We're up about 15% for the year. We've had a great year. We've made up the small loss we had for the COVID. And so everything's going well. And now they're wanting to take their money out of the market because they're concerned about the election. But the election's, like 3 months away. There's plenty of time to worry about that. But somebody's always got something to worry about.
Well, every presidential election is unlike every presidential election before it, and absolutely determines the future fate of the world. And is my guy going to win, or is the other guy going to win? The politics of it all, the uncertainty of it all, the sensational headlines of it all. There's emotion tied into that. There's emotion tied into politics, period. But then when we see how it could directly impact and affect our money, or we believe that it might, those emotions get heightened. 2 things come to mind. One is a pretty old joke. I'm sure you've heard it, John, but how do you make $1 million in the market?
Start with 2.
Start with 2. Yep. And then the other one is a chart that I saw, and it had the picture of kind of the sine wave of the market. And at the top, it said, get excited and buy in. And at the bottom, a little arrow, and it said, panic and sell out. And then the heading at the very, very bottom, the footnote was repeat until broke.
Yeah.
and I think that is pretty apropos for what we're talking about here today. Emotions in your money, 5 potentially costly mistakes that a financial professional can help you avoid and break that cycle of emotional investing, because at the top, when we're euphoric, that's really when we have the greatest risk of loss. At the bottom, when everybody's panicking, there's another old saying, where there's blood in the streets, there's money in real estate. And that's kind of a gory analogy there. But when people are panicking, that's when there's the greatest opportunity for gain.
Oh, sure. When the market's down is when we want to get in, not at the top of the roller. It's like the roller coaster. You want to get in on the roller coaster at the bottom. You don't want to get in at the top because it's a long climb to get up there. So it's easier to get in at the bottom and make the money as it goes up. And, the thing that we have to remember is that a long time ago, I learned that everything runs in cycles. All business is basically cycles. And so every company has cycles. And so we just need to remember that. And we don't need to panic when the stock market is going down. We might need to reallocate. But, as I've always said, it's the risk factor. How much can you lose and still sleep at night? And that's where your risk is. But, you got to have some money in play. You can't put all of it under the mattress, which is what this person wanted to do, was take all their money and keep it at home, which wouldn't hurt them anything. So not a wise decision. Hopefully we talked them out of it.
Yeah, well, we will talk about that emotion in just a moment. But the first
Yeah.
on the list, John, is one I have to say, I have to admit, I have been afflicted by this one, impatience. I've got a little account. I call it my mad money because my wife gets mad at me about it. And it is where I have some things where I'm shooting for home runs, right? It is my play money account. But I always seem to feel like, hey, right now is a great time. It's an opportunity to buy XYZ at a very low price, because that's obviously going to do a whole lot better than it's currently priced at. And so I buy in, and for the next 2 or 3 weeks, it goes down. And I say, I can't take it anymore. I obviously was wrong about my intuition. I sell out, and without fail, it shoots way, way above the original price that I bought it for. I'm not patient enough to stick with it. I don't have the discipline. Impatience can lead to costly financial mistakes.
And that's true, Peter, just about everything. I mean, every time you do that, you buy in, the stock goes down a little bit, or it loses a little bit. Take a look at Tesla. Tesla goes up and down, up and down. If you got out a couple of weeks ago, you were at 1450 or 15, and now it's over 2,000. So, that you've got to have the patience to stay in. I think the chart said the average investor makes a little over 4%, whereas the market's made over 10%. So that's the problem is the average investor can't stick with it long enough to make those returns, because they want to hit that home run. And everybody has that account. I encourage my clients that, if you want to do that, take a small amount of your money away from me. And you do that all day long if you want to. But, let me take your money and let me grow it, and I'll be conservative with it. But, you can play with it and you're not going to lose a lot. And they do. And some of them feel good about it. Some of them come back and say, here, take this money. I don't have the patience for this.
Take it back, John.
Yeah, just take it. I don't want the responsibility.
Yeah. You've got the discipline approach with the majority of the funds and the money that we're really going to depend on, and then allow them to have some mad money, some play money.
Right. And I think that for a lot of clients, that kind of appeases them and gets their gambling, if you will, out of the way. But the average investor doesn't have the technology or the time to sit there and watch that stock go up and down all day and try to pick when they need to get in and when they need to get out. And as you know, as well as I do, a stock can be up in the morning and down in the afternoon, and then back up the next morning. So impatience is certainly number one, because it is hard. It's hard to decide when to do that. I think that kind of goes along with number two, which was overconfidence. Peter, you hit that home run, and then all of a sudden you think you're a stock jockey and you're a guru. And so you get overconfident in your investing, and you forget to allocate. And that's really what we want to do, is we want to allocate among different segments. As well as I do, if we look at that chart that we get every year, the stock or the mutual fund or the sector that was number one today it ain't going to be number one tomorrow. Usually It can go from one to the bottom.
Yeah.
And so you need to reallocate.
Well, in 2007, the leading asset class was emerging market stocks. Yeah. And in 2008, that was the worst performing asset class. And there's they call it the periodic table of investing. It basically shows all of the different asset classes throughout the years. And it's so scattered. There's nothing that is consistent about it, except that cash is usually right about the middle. It's not the worst performing. It's not the best performing. It's just, if you just sit in cash, you're about middle of the road there. But John, those two, emotions, impatience, overconfidence, they lead to emotional mistakes. That chart and the study that you referred to was the quantitative analysis of investment behavior by the Dalbar Institute. They have studied investor behaviors and returns versus the market index and consistently shown over 30 years of conducting this study that investors underperform the markets significantly, and it's usually attributed to emotional decision making, whether it be impatience or overconfidence, or the other three emotions we're going to cover here. But to avoid that trap, John, working with a financial professional, not thinking that you need to chase performance and returns, can help you have a more disciplined approach to long-term success.
Well, I think that's right, because that's what we're trained in. We have the technology. It's something we do every day. I mean, we're constantly reading news. We're looking at, we're getting emails in about sectors and what's moving, what's not, economic news, business news, the whole thing. So all that, and governmental news, because that also affects the stock market, as we know. So that's what we do all day long, is analyze that. The normal investors got a job somewhere else. They're not doing that, and they don't have time to do that, and they don't understand it. They understand stocks, but they don't understand what's going on behind the scenes. And they don't have the different softwares that we have, that we analyze these stocks and get really deep into the analysis of, how much they're making, what their yield is, consistent dividends, things like that are all the things that we look at. And then, of course, the buy-sell ratings that we naturally get because we pay for them, where the average investor won't pay for that. So it's really something that an advisor should be able to help the investor with, and should be able to keep them in the market when they need to be in the market, and help them reallocate to be more conservative when they need to be. But the one thing about it is that, they say it's not when you got in the market, it's the time in the market.
Yeah, and because the average investor does not have all of the information that you spoke about, they could be like the example of the investor that you spoke about, fearful of getting in the market because of maybe lack of information or lack of foresight and clarity on what will happen into the future. So we hold all our money in cash, and yes, it's not usually the worst performing, but we also don't get a whole lot of growth over and above inflation that we are going to need to have long-term financial gains. So fear, waiting too long to get back in, or not getting into the equity markets, is an emotional mistake that investors make that causes them not to have the gains and progress that they otherwise could.
Well, sure. And I always think back to the prospect that we met with, and he told me, he says, all of my money is in the cash, and because when the market went down, I went into cash, and I thought, well, that was in 2008. That was great. He said, oh no, I did that in 2001. And this was 2018 when we were meeting with him. So for 17 years, his money sat in cash.
Wow.
Making nothing while the market was going up. And the market was going down, but overall, the market, as we've seen, has averaged over 10%. So, why have it sit in cash for all that period of time? But the thing is, he got out because he was fearful. Then he was fearful to put it back in because he didn't know when to get back in. And so he was afraid he was putting it in at the wrong time. So he just sat there and didn't do anything. And that's the worst thing we can do, is procrastinate.
Well, it's not an all or nothing proposition either, right, John?
No,
I mean, dollar cost averaging would perhaps help an individual like that not expose all of their money to the market, but begin the process of getting comfortable in the market again.
Well, Peter, that's what we do right now. Is if a client gave us $500,000, we're not going to take and invest all of that today. We're going to slowly put it into the market on several days, several weeks, maybe even a month or two, because what we don't want to do is put it all in and then have the market go down. So what we try to do is not, like I said, time the market, but what we try to do is put it in over a period of time, so that if the market is going to go down, we'll pick up different price points. And anybody can do that. But here again, the average investor doesn't have the time to sit there and drip that money into the market or know what to drip it into.
Well, again, we are talking about emotional mistakes that investors make and how having a qualified financial professional for guidance can help you avoid some of these emotional mistakes. If you've got questions or concerns, if you'd like to look over your portfolio, pick up the phone, give Gulf Coast Financial Services a call, 386-755-9018, 386-755-9018. They can formulate that long-term plan with the outlook for the future. They can hold you accountable to it, make sure that you are sticking to it and not making emotional mistakes or knee-jerk reactions to the market, because it certainly is volatile, and we as average investors, emotional human beings, have the tendency to react when we see it go one way or another. Again, you can also go to GulfCoastFinancial.net, GulfCoastFinancial.net. Lots of additional resources there. John, right now, I think this year, perfect example of this next one, when we saw the onset of COVID and the quarantines and the economic shutdown, a lot of people panicked. Panic is never a good emotion to make rational decisions.
No, Peter. And what happened was the market went down very quickly. I mean, it was boom. The COVID was there. It hit the United States. The market took a big plunge. So if you got out and were in cash, you would have missed the rise back up, plus the 10 or 15% that the market's done since. So, that was a typical example of being in a panic and being the wrong time to totally get out and not get back in. Now, if you got out at an early point because that was your strategy, that's one thing. But to get out because the market was going down and keep the money in cash, that was not the right thing to do, as we saw, because the market recovered very quickly. And so we actually, therefore, this year's turned out to be a good year for us. It's not as good as last year, but almost as good. And it may be as good by the end of the year. But so far, I mean, we're doing pretty well. So you had to be in the market. But panic, that was a time to panic because there were a lot of people panicking. We sent newsletters out. We sent letters out every day there for a couple of weeks, calming our people, telling them what we were doing, telling them what we thought, telling them where we were in their investment cycle, and what we had planned to do as a company to protect their money. So we didn't have anybody that really panicked and took their money out totally, but we tried to calm those fears. And that's what a good financial advisor does. I know that's what you do.
Yep. Stay calm, maintain your long-term focus, talk to your financial professional. They'll help you stay on track there. But John, with everything that's going on, it's easy to sort of get lost in the fog of investing. And you've talked about procrastination, not being progress, not being proactive, indecision. Just not making a decision on something is another emotion that can cause long-term financial mistakes or hardship, or at least not making the progress that we should.
Well, that's right, Peter. And I think we look at this Morningstar report from 1926 to 2016 that shows that if you invested in cash and it earned 3.4% over that time, with inflation and taxes, you actually lost minus 0.8. So you didn't make money on that time. Whereas with stocks, even with taxes and inflation, we were still at 5% ahead. So, that shows you there that we can't keep our money in cash. We have to be invested in something. Taxes, inflation are going to be there. As we've talked about on this show numerous times, taxes are going up. They are going to take more of your retirement dollars. And so we need to make as much on those dollars now as we can.
Well, again, having that qualified financial professional to provide guidance, to keep you accountable, to hold you on track can be beneficial in avoiding some of these emotional mistakes. Give John Kuykendall and his team a call. They've been voted best of the best in financial services 5 years running by the Lake City Reporter. 386-755-9018, the number to call, or you can go online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, another emotion that we have, we are competitive. And we like to gauge our results. And so a lot of investors probably have a couple different metrics. They might compare their results to their friends, their circle, their family, their coworkers, or they might compare their results to a market index. Are these fair ways to gauge our results when we are investing?
Well, the one problem with market indexes is that, as we know, the top 15, 20 stocks of the S&P 500 make up 80% of the volume of the S&P 500. So you're heavily weighted into tech, and to, Apple and Microsoft and those. So,
which was one of the problems back in the tech bubble, right? Was people were too heavily weighted in one sector.
Well, yeah, in 2000, everybody wanted to be in tech. And when tech went off 50%, everybody lost their money. And so that was a problem. You thought you were allocated because you bought all these different mutual funds. But the thing was that all of them had the same stocks. And that's why you need to know what they're really invested in. But, you need to have some kind of index or that you look at. But the way I look at it is it's more consistent. If I have a plan, and if I have a retirement income plan, I know where I need to be. I know what I'm doing to get my income. I've got my predictable, sustainable pension, private pension set up. I've got my Social Security. Then I need to know what my portfolio is going to do. What my portfolio does over time is really not going to bother me as much. So I'm probably not going to be as competitive because I've got a plan to live by. And that's the problem. Very few people have plans. And so they're flying off and retiring and hoping that it's going to be enough money to last. The thing I always like about competitiveness is when the client comes in and says, my neighbor said that he made this, and I don't know why you don't make that. Or I was talking to a good client who's a good friend of mine now, and he was telling me the other day, he says, my cousin got into this and he really made money. And so I said, okay, hold on a minute. So I pulled it up on the graph and I said, when did he get up in it? Well, the cousin got into it at the right time. If we got into it, it would have been at the top of the graph, not the bottom of the graph. And so you can see why the cousin made money, but there's always a reason.
And it's also, we have to gauge it for our individual goals and objectives, right? So if the cousin or if the market index is up 20%, but our stated goal with our money is preservation and protection and to be conservative, then that's not a fair gauge for progress. And likewise, if our objective is for growth, then maybe more conservative options would not be a fair gauge for progress. It's all going to be dependent on what we have outlined as our long-term objective. And again, having that financial professional to help provide that guidance, John, that's going to be a benefit in bringing that into perspective to avoid some of the emotional mistakes.
Oh yeah, but the thing of it is we all want to be winners. And that's the reason that we're talking about this now, is because I've often said that the American person, public, they don't like to lose. And so when you see that your stock is down 5% and you bought it 4 days ago, you feel you've lost. So emotionally, you've already taken a hit and you're going to end up selling that because it's not what you want to see. So emotionally, they do that, but everybody has like I said, their own risk tolerance, their own objectives, their own financial plan. And we look at their age and all that. So you have to follow your own plan and not try to follow every hit run. I think back to the guy who came to me back in 1998 and was upset because I hadn't put him in the Jacobs Internet Fund. And so I told him, I said, I'm not putting you in it, but I said, if you want to take $10,000 or $15,000 out and put it in, that's fine. You track it, you tell me how it did. So after 2000, I started laughing at him because the Jacobs Internet Fund went broke. And so he lost his money, but we still had ours because we were diversified and we were following a plan. So you can't follow those particular things that you think are going to do. You got to look at the overall plan.
Well, again, having a plan, Having a financial professional to provide guidance and perspective along the way can help you avoid some of those emotional mistakes. John Kuykendall and his team do offer a complimentary review, a strategy session. They'll help you look at the risk exposure that you have in your portfolio, help you define your risk tolerance, make sure that they're in alignment, make sure you're getting what you're paying for, not paying excessive fees or commissions, not missing opportunities, being efficient with your money, helping you translate and transition the lump sum into the income that you'll need for retirement, identifying opportunities, protecting what's most important. Pick up the phone, give them a call, 386-755-9018, 386-755-9018. All that said, John, we do have to acknowledge that this is a pretty interesting time, and we could definitely see how emotions are running high in the world in general and with our money right now.
Well, with COVID going on and all the social distancing, I was listening to the radio the other day, and some country singers got 6 feet away as one of his song, and how happy he's going to be when he can go to a baseball game. It's interesting times, and I'm not sure what normal is, and I'm not sure if we're going to know what normal is for a while. So therefore, emotions are high anyway. And with the election coming up and all the politics going on, local elections, other things, certainly these are emotional times, but the market is still doing well. And we need to be in the market in order to make the money. So we should calm our emotions, talk to our advisor, and stay invested.
Well, again, John Kuykendall, his team there at GulfCoast Financial Services, there to be that reassuring resource for you. Pick up the phone, give them a call, whether you are just getting started in your progress, whether you need a checkup and a progress report, whether you are hitting a milestone or a major transition, or you want to define that plan, implement that plan, and stay on course. Pick up the phone, give them a call. 386-755-9018. That's 386-755-9018, 386-755-9018, or GulfCoastFinancial.net. John, we always appreciate your time. Thank you for being here.
Thank you, Peter. It was great. I enjoyed the show a lot. I love this topic.
Absolutely. Well, we always appreciate the time with John Kuykendall. His team is standing by, and they are willing to help and assist. They are a resource for North Central Florida. Give them a call, 386-755-9018, and we'll talk to you real soon.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.